Every real estate investor that we work with loves a good deal. And one of the most popular ways for investors to purchase property in recent months has been using a strategy commonly referred to as Sub2, or buying a property subject to an existing underlying mortgage. There's a lot of confusion, a lot of questions that we get from clients of varying experience and skill levels on how to properly insure a Sub2 investment property. We're going to unpack that and give you some quick best practices for your real estate investment operation right after this intro. So when we're talking about insuring a Sub2 investment property, one of the most important things that we need to be clear on is exactly how to go about putting the right people in the right seats on your insurance program. A lot of Main Street insurance offices don't have a clue how to do Sub2 investment properties correctly. A lot of times they say they can, and then they end up making a mistake, not writing the policy correctly, and risk getting the due on sale clause triggered by the underlying mortgage. If you're not familiar, a due on sale clause is what happens when a mortgage company learns that a property that they wrote the mortgage on has been sold to another party. They will then trigger the due on sale clause for their underlying mortgage, which means that the amount that's left on that mortgage is due in full, because the party that had the mortgage is no longer the party that owns the property. So one of the most important things that we can do as your insurance partner is make sure that the policy is written correctly and delivered to the mortgage company with as little fuss as possible to make sure that the due on sale clause is not likely to be triggered. So we're going to run through the roles on a Sub2 investment insurance policy, real quick. So we're going to start with the first named insured, the primary named insured. This is going to be your investment company, or if you're buying it in your personal name, then you as an individual. First named insured is the one in control of the policy, the one that will receive the claims distributions when there is a claim in the future. One of the most common questions we get for investors that aren't as familiar with how to insure this kind of investment property is it okay for me to leave the seller's policy in place and just ignore buying insurance entirely? There's a lot of reasons why we don't suggest this, but the most common one is control. You want to make sure that you are in control of the insurance process, that you and your company or your name are first named insured on the policy, because you get to be the one to receive the claims distribution. You get to be the one to decide where the policy is held and if it needs to be canceled for some reason. A lot of people will choose to leave the seller's policy in place and purchase their own policy in addition. This is a double insurance situation that's entirely unnecessary if you are setting up your insurance program correctly. So a lot of times we will find someone after the deal has already been done. In those situations, we're going to immediately set up an insurance program for the property and send it to the mortgage company, thus replacing the coverage that was previously in place by the seller. So just as a quick aside, as a best practice, you definitely want to get rid of the seller's insurance policy after you have successfully replaced it with one of your own. We always recommend waiting at least 10 business days after submitting your policy before canceling the previous policy, so there's no red flags or triggers with the mortgage company. So going back to the right roles on the policy, your company is going to be first named insured. First lien holder or first mortgagee is going to be that underlying mortgage that was on the seller's policy. We're going to place them on your policy because they still have a lien on the property, and that's the first thing that they're going to look at when they determine whether or not the insurance document that you send them for the new insurance is actually valid or not. A very important step that we're going to do for the third role is listing the underlying seller as the additional insured party on the policy, because you got to remember the person at the mortgage company that is doing the insurance verification is almost certainly an entry-level data entry clerk sitting in a call center somewhere, not exactly the most sophisticated of individual at the mortgage company. So they're going to be looking for, one, is the mortgagee, the mortgage company listed correctly, and two, is the person shown on that mortgage listed on the insurance policy. So we have to list the underlying seller as an additional insured party. So those three things for a standard sub-2 are really what we need to be doing for the roles on the policy. First named insured, you or your company. First mortgagee, the underlying mortgage company, and additional insured party is going to be the underlying seller. Aside from that, we want to make very sure that we are waiting those 10 business days after you send your replacement insurance to the mortgage company before we cancel the seller's old policy, so nothing gets triggered with the mortgage company. If you have any specific questions about Sub2 Investment Property Insurance, please let us know. My team has done literally hundreds of these deals. We know exactly how to do them correctly. We are the preferred insurance partner for several masterminds that focus on creative finance. So we are basically the go-to for this type of property everywhere in the states that we operate, which is 36 states and counting. So thanks for watching. If you have any questions, you can reach us. The information here on the screen, info@riskwell.com, or call us at the office, 469-678-8001. Please remember, boys and girls, life is risky. Risk well.